Ladies and gentlemen, our moderator for this discussion is Mr. Vivek Mandhata from BCG. Let's give him a big round of applause and welcome him up on stage. Thank you, sir, for joining us. And now taking the pleasure of inviting all our esteemed speakers and panelists here amongst us. Please welcome Mr. Shirish Bhandari, IDFC First Bank. Thank you for joining us. We also have amongst us Mr. Amit Sinha from Yes Bank. Please do join us. And keep the applause going, ladies and gentlemen. Thank you so very much. We'd like to welcome Chitrabhanu KG from the Federal Bank. Thank you so very much, sir, for joining us. And we'd like to welcome Mr. Subhrangshu Chattopadhyay, CRIF. Thank you so very much for joining us, sir. Let's have a big round of applause once again for all our esteemed panelists. We're looking forward to a great round of knowledge sharing and knowledge gaining from our esteemed panelists. And with that, I hand over to our moderator, Mr. Vivek Mandhata, sir. Please do take this forward.
Thank you so much. Good morning, everyone, and excited to be back at GFF again, 2024. The topic itself is an extremely interesting topic because this is a space that has really dynamically evolved over the last few years. When we talk about consumer credit or even credit cards, different forms of consumer credit, we've seen 20+% CAGRs in the last few years. Credit card spend itself going up by 40%, 100 million carded consumers in the country. This has been a rapid evolution. Obviously, underlying that, there have been many more themes and trends that have played out and will play out as we go forward. I look forward today to have a rich discussion with our panelists here on this topic. Let me get this started with just talking about data first. Right? I mean, we've always used data and data-backed decisioning in credit. Right? But the form factors of data has really expanded in the last few years from the traditional modes of, say, ID return or a physical proof of information. We've now moved towards a lot more richer ecosystem of alternate data. Maybe I'll ask all the panelists to just react to the overall theme and also talk a little bit about the new forms of data that you've already started using in your respective business models. Maybe you start with Shirish and go around.
Thanks, Vivek. Good morning, everyone. So the continuing rise of big data, digital analytics have, I would say, unleashed very significantly new opportunities for banks. And the inputs to the credit decisioning models, which basically underpin the lending processes, is something which is taking shape. Obviously, banks today rely largely on traditional data, but there is a calibrated shift towards non-traditional. And if I have to explain, there is a traditional data which we use in terms of transactions of customers that they do in the bank accounts or their other products with the bank. But added to it is the non-traditional internal data that we have started kind of looking at, which includes a customer's conversations with the banks. It could be a CRF data, and so on and so forth. And we are then trying to enrich it with both traditional and non-traditional external data. Now, which includes, for example, telecom data is a significant indicator of a customer's behavior. Then there are non-traditional sources, for example, the social and professional networks that the customer is into, which is again very revealing, I would say. And these are things which are in progress. Obviously, with the opening of account aggregator, now we have, we can actually look across different accounts of a customer and can actually estimate their true income, which is also a significant, I would say, input into the models for us to be able to know a customer. Like I was talking about the telecom data, right? Majority of applicants that are now kind of applying or being wanting to be a part of the banking system they lack credit history. Now, the way a telecom data can reveal in terms of their behavior, the way they call and text, the way they are making payments, that itself is also becoming significantly important. And if you add to it, let's say, UPI transaction behavior, or let's say, for example, us as a bank, IDFC was like a leader in FASTag. And that also gives a significant amount of, I would say, visibility into the affluence, basis the vehicle, the make and mode, and the places where they travel to. So I would say significant amount of progress, enough and more data available. I think the key is to kind of organize this and see how we can best use it to kind of take forward this credit expansion. Thank you.
Amit, anything else you'd like to add on the data front?
Over the last 10 years, we have moved from data is coin to data is coin. And, the primary raw material, which is driving this entire discussion and this entire fintech economy is data. I mean, without that, the raw material itself is missing. And banks, per se, sit at the top of the pyramid when it comes to consumers' financial data. However, over the last 15-20 years, from banks' internal data, then we had very, very rich bureau data. Earlier it was core, then we had CV variables. And now you have plethora of other sources of data, right from food delivery to utility payments to OTT behavior, which can be converted into behavioral models. And then you can draw inferences in terms of customers' ability and intention to pay. Banks bureau in fact solves for the intention to pay. However, for ability to pay, especially for a segment which is underserved, that is where the core of the problem lies. Okay. Now, how is this data getting generated and what is driving this whole thing? One is the amount of digital footprint that we are leaving every time we pick up our mobile phones for doing any transaction, whether it's a financial transaction or a non-financial transaction. We are leaving a trace of our life for the world to know. So, leaving digital footprint is one large aspect of driving this entire fintech economy. And second is our ability to share data through APIs with each other. And the ecosystem which enables that without violating privacy laws, you can share data with each other based on different use cases.
As you get in on the conversation, any particular data sets that you found powerful, that you added into the mix in the last few years?
As an initial comment, I believe that we have got a problem of lending. So data is available in various forms. So, we were using, for example, structured data, which is mostly the bureau data which they were talking about. And that seems to have been very useful for us for the last 5 or 10 years. And add to it, we find that there's a lot more enrichment in this data. So the recent regulatory guidelines of having this updated on a 15-day basis has come very recently. So we feel that that's going to help us as banks in getting an updated data. I'm sure it's only time before this becomes updated on a live basis. I'm sure at some point of time it's going to happen because the entire underwriting is done. I think a large part of the underwriting of banks is done by this data. So primarily I believe most of the banks, I think 80-90% of banks have been using bureau data to some extent, though we have been talking about a lot of other telecom data, etc. But for the pure underwriting of the customer and deciding on whether you can give him, taking a decision, it's been always the primary data. Then you have other data, like for example, if it's an honest customer, you already have got data on the accounts of the customer with us, the transactions with us, and all those details are already available with us. So in that sense, for a bank, we have a rich set of data, the account aggregator which is expected to, which is at least taking steam to some extent. You get an offers data of the customer also. You get to know what is his balances with other bank. You have the GST data which has come in. So all these things seems to be at various stages. But how do we use this data and create insights? That seems to be one which is most important at this point of time. So I believe that this is no more a science. It's turning from a science to an art. Do you have a good painter who can paint the real picture of a customer? A profile of customer is what I think we should get into. You have data, but how do we use it is going to be the next most important thing. We are doing it in bits and pieces, but I think there's a lot more to go.
Thank you for teeing it up so well for me to bring you to Subhrangshu, because I mean, from your vantage point as a bureau, right, I mean, you played a critical role in traditionally bringing models, scores, use of data. Right? Data is your life in a way. Right? So, how do you react towards Chitrabhanu saying that we have a problem of plenty? How do we use it? Is still evolving. Any thoughts on that?
So, I think broadly 4 areas that we are seeing. First is that the choice of the data asset should be based on amalgamation and not substitution. So it's not a question that you can only use non-traditional or you can use traditional. The swap sets come in when you amalgamate both the traditional and the non-traditional. That's the first thing. The second thing is, we are seeing a preference by regulated entities to make investments in data assets that are scalable through regulation. Because it's a less risky approach, those data sets will stand the test of DPDP. It's as simple as that. It's a fundamental data strategy that we are seeing. The third thing we are seeing is that even if you have banking, even if you have income, entities are now trying to become more sharper. So I have income, but actually what is real income, what is real expense? Separating a bank statement, drilling it down to saying, okay, in my bank statement, these are possible incomes, but really this is disposable income. Fundamentally, sharpness of what is available. So it's no longer an efficiency game. It's largely an effectiveness game. The fourth thing we are seeing is marrying of the traditional and the non-traditional for portfolio management and debt management, beyond underwriting as well. So you look at banking, bureau, and underwriting. Can I do banking plus bureau to better early warning, to do better expected credit loss, all of those things we are seeing. And finally, from a market entry, market divestment strategy, we have seen people use publicly available data. So in the bureau, we've clearly seen a causal effect, for example, of two-wheeler delinquency. The effect being two-wheeler delinquency, the cause being completion rate of roads. So usage of publicly available data for making decisions, whether I invest in this, whether I divest in this, whether I retain, that's the theme that we are seeing. So 5 broad themes that we are seeing from a data strategy and usage standpoint.
The common topic that I hear, right, is formalization, payments, data coming in. I read payments, so I love that topic of payments, and that's a commonly talked about thing that bank statements have now gone from 10 pages to 50 pages, right? So there's more granular data, etc. But that also comes with challenges, right? So I think you were touching upon it briefly, but each data stream has its own richness of information, whether it's UPI versus cards versus something else. So reading that, interpreting it, and converting it into usable information. What's the journey that we see? Maybe Amit, if you can chime in on that.
So, see, banks today, when I say banks, I'm talking about the financial services industry. Payments has grown much faster than other segments of banking, whether it is retail lending, etc. At least in the last 10-15 years, that's the perception one gets, that payments is right now the fastest growing segment. After UPI, of course, we all are inundated with information about the scale of UPI volumes growing month, etc., etc. So, as Chitrabhanu rightly pointed out, it is a problem of plenty. There is too much data. One has to figure out how to make sense of the data and how to use that data for underwriting decisions. All data may not be useful. It may just be quantity, but the quality of the data and to find the right variables and the problem with risk is that it is unknown. You only come to know about the implications of your decisions after a decade or maybe after 4 or 5 years. Okay? So somebody has to take that leap of faith and create that data mindset and live with that decision, fire your shot and bear the consequences. Now, that is where we have seen that very measured steps are being taken. And as I said earlier, bank being at the top of the pyramid, whatever approach banks will take will trickle down. Okay, to NBFCs and then subsequently it will trickle down to the Fintech ecosystem. So, I think somebody has to take that leap of faith in saying that we have done enough experimentation, enough validation, and we believe that this model will work, and then put its might behind it. I think right now, the pace of change is slower than what it should have.
Shirish, any thoughts on how you have been looking at going past these challenges and actually leveraging the data?
So I look at it from two perspectives. One is the information flow and the standardization of it, right? A classic example in front of us is, let's say, a CKYC registry, which multiple financial institutions contribute to, but then its shape and form is still not standard, right? There are challenges in large parts of information there is unusable, versus, let's say, a bureau data where things are standardized because they are being managed by someone who are into the space of managing, assimilating and exposing the data for financial institutions. So that is one part of it, that how do we standardize the information flow. But the second important part also is that how do you kind of aggregate that data for it to be a widely input or multiple series of widely inputs into your decisioning models. One approach is to have an optimized algorithm running over a consolidated database. Second would be having a submodular architecture, where you have different data sets which at different points in time can be integrated, edited, changed, added to, and that is what I would say financial institutions prefer. Because for example, a scenario like COVID, you can quickly have a submodule integrated into this whole thing to fine-tune your credit decisions. So the way information flows and how much of the standardization is available, so that a large part of it is usable. Plus, how do we kind of aggregate and build that right architecture for it to be used selectively to open up new business opportunities or to basically mitigate risks. I mean, both of these things are critical.
And as we expand the conversation into the models and the risk model side of the house, right, and how are they evolving with all of this data, right? Because lending is the toughest part to provide a great experience, right? So payments is easy to provide an experience because it's money moving from point to point. Lending, it's easy to give the money, but how do you collect, right? How do you ensure it's collectible is always the challenge, and therefore there's a balance that we are always trying to strike. So maybe Subhrangshu, if you could tell us a little bit about how risk models themselves have evolved, and I'm also feeding off what Amit said, saying somewhere you have to take a punt in some of the new models because they will always not be demonstrable at the beginning, right? So how do you see the credit risk models having evolved already or about to evolve?
So I think it's very important to understand what's driving consumer credit. So if we go back 3-4 years, you typically find someone landing in a credit bureau with the first product being a two-wheeler, a small home loan, something like that. Over the past 3-4 years, a lot of people landed in the credit bureau with a buy now pay later footprint. That is fundamentally a very different population, and they are the people who will take the next loan because theoretically their leverage is not there. So people who've done well in this space, for example, have said, does the bureau score give me a directional marker in line with the product construct? Because the product itself is a 6-month product. The bureau score is tuned to look at 12 months. So it's a directional marker. It's not accurate risk marker. So people have worked with us, we have worked with people to migrate them
to a much more aggressive underwriting definition in this case. If you look at the credit card space, about 70% of cards issued have limits less than 50,000. Fundamentally, very different population. So, you need to look at emerging sub-segments in the model because the volume of this segment is such that it's an irreversible trend. So for us to be able to control risk and get the right acquisition, super important to make sure that you are using markers that tie into the product construct. And what this means is that typically we say anyone above 750 is a good customer. Now we all may be 750. But if I am coming from 850 to 750, and Chitrabhanu is going from 750, and you are going from 650 to 750, fundamentally very different risks. So it's very important to look at, even think of the bureau data as non-traditional. So stop looking at the point in time bureau data. Look at trends, because we've seen it differentiates risk. It differentiates risk. Secondly, if you look at banking also we've seen have different use cases. So for someone who has a thin file on the bureau, someone who has a medium risk on the bureau, the banking treatment is risk. Someone who is good on the bureau, the income treatment is from product and pricing. So fundamentally very different things. So the evolution has to some extent happened in terms of the mindset that I need to look at markers that are aligned with the product construct. What needs to happen is to some extent the IT evolution to be able to consume all of this in decisioning, so that you get this decision consistency for a large number of applications. I think that's where we are.
And risk models obviously go beyond just underwriting, right? So Chitrabhanu, as we look at risk and as we look at data, the risk of fraud naturally comes into the conversation, right? Both in terms of impersonation fraud or even data fraud, right? So as we go more and more into relying on data, right? How do we factor for fraud?
I agree that becomes very important. As he was mentioning, I think he's covered most of the areas about what a credit model is. But we have evolved quite a lot now. As a bank, maybe 10 years back, we had only very static models, mostly. But that's not become more dynamic thanks to all the new machine learning, AI capabilities, etc., which have come, which is mostly now self-learning also. You have all these models which is learning on the floor. And since this has all become digitized now, maybe you think of 10 years back when you have a housing loan to give, it's very static in some sense. You have time to decide on whether you want to underwrite yes or no. But now your customer expects you to give a go-no-go decision on the fly. So once that happens, you require so dynamic models which will be able to not only understand the customer in terms of a credit risk, but also in terms of the frauds which you talked about. So it's actually a challenge. You don't have an FIRC where you can go and check whether the customer is a salaried guy somewhere else. You will have to find ways of doing it within your model or at least within your framework. So that becomes a big challenge in some sense. We have a lot of tools which is available in some sense which you can get, but I think this is only evolving in some sense. Most of the times I'm sure is facing in some sense challenges under this, but I believe rather than credit risk in some sense can be managed with all these models in terms of the bureau data, in terms of all the other data like the savings account data, etc. is available, which is already put into your model. You train them, you test them, and you are able to identify whether this set of customers will get into an NPA 30 plus or 60 plus, whatever it is within a period of time. It's easier to identify. But identity is something which is sometimes very difficult. Though you have all the CKYC, etc., which is available, but in spite of all these things, there are fraudsters going around. So how do you identify a customer and ensure that you are giving it to the right person? It's sometimes a big challenge. You have hunters, scores, you have all these things available to some extent, but I think there's a lot more to do in that space. Fraud risk in some sense seems to be a bigger challenge than the credit model, I believe. So integrating that into our platforms before we decide on giving us something which we have to work. Maybe with a lot of other partners, non-traditional data, So for example, what you just talked about the telecom data, maybe it will help us to understand about the customer, how he's using his mobile phones, etc. So these are the areas where we may have to work further, which I think is in progress with the help of a lot of fintechs which is working in this space.
The evolution of data. Sorry, you wanted to say something?
Yeah, I was saying, see, if you look at it from the bank's perspective, okay, what is the need for the bank? The bank wants to reach to, geographies where it cannot reach physically. So, of course, digital lending becomes important. It helps in distribution. Second is that if you are able to, curate a scorecard which gives you lower risk and you are able to underwrite at lower cost, okay, that's the benefit to the bank. Now, we have been hearing about next 0.5 billion people to come into credit code. That's only possible not by physical distribution but by way of digital. And most of it would be unsecured because on the secured lending side, a lot of digitization of the infrastructure, back-end infrastructure is yet to happen. Okay? So, problem, if you take one example, okay, one of the largest NBFCs into consumer credit today, they cracked the scorecard much before the whole ecosystem started talking about scorecards. Okay, so for example, the realization was that bureau data for a segment where most of the customers are taking first-time consumer product is not available or is not holding well. So a scorecard was created based on the time you are buying a mobile phone, what product you are buying, what time of the day you are buying, which store you are buying it from, which model you are buying. And basis that a scorecard was created by doing various validations, and that scorecard holds very well and it helped the company approve a loan in 30 seconds, and that actually is one of the reasons for their success. Okay, so that's probably where the genesis of scorecard started. Now, for NTC customer, how do you create a scorecard when bureau variables are not there is what remains as a challenge. Okay? UPI payment data, still the ticket sizes are very small. Basis number of transactions, I don't know what kind of inferences you can draw. And maximum you will get one or two variables. And one or two variables do not create a scorecard. You at least need hundreds of variables, then you backtest and you finally arrive at 10 variables, which can help you create a scorecard.
Well, you preempted my question, so let me go to Shirish then, because I was going to ask exactly about the new to credit segment. We've seen that segment scale up and then slow down as well, right? So in the last 1 year, if you see the mix, the new to credit has kind of tapered a little bit, right? So is the availability of data really unlocking our ability to serve that segment, or is it still early period, like Amit is saying, where we'll have to see how this evolves? It'll take a little bit more time for us to provide the similar experience to a new to credit consumer that an existing to credit consumer is getting, right? That normalization of saying I'm able to treat them similarly, will that happen soon enough? If so, what will it take for us to get there?
If I could also touch upon the previous one just 2 minutes before
I think everyone is very off for order, so please.
So, because the risk has moved from ability and intent only to fraud now, right? And, front and center of this problem is that the consumer's expectations are significantly rising. Thanks to social media where personalization has become sort of granted, and thanks to e-commerce where rapid deliveries have become sort of a norm, right? And the banks are like banks, fintechs, all are creating the cutting down the journey times, building a lot of experiential stuff into the journey, and which basically also results in a lot of social engineering by fraudsters. Because they have studied the consumer protection models so carefully that they are now capable of gaming the system. And because the opportunities are so humongous, they are able to move from one bank to another in a short span of time. And which has resulted in sort of from a third-party fraud to a synthetic fraud to now first-party frauds, right? Where the customers are just feigning ignorance, right? They would claim that okay, the money has not been drawn out of ATMs from one bank to another, and then try and flees the entire system. So it's very important that one multi-factor authentication across each KYC node is undertaken. Overdoing KYC is obviously important, but the larger part for, I would say, for banks to understand or fintechs to understand is that cutting down journey time is not a solution. It's important that the customer ease of application is very important, and which is very different than cutting down journey times. Obviously, there is a saturation cliff beyond which obviously a journey time cannot extend, but there is also a saturation plateau that below which if you cut the time, there is no value. So there has to be the right balance of ease and I would say checks and convenience, but not completely relying on journey times. So that's part one. The second part about the new to credit, I'm a big fan of that segment because the genesis of the business that I started at IDFC has been to span credit. Right from 9% APR on a credit card to lifetime free, basically removing all barriers so that new customers are brought into the credit fold. Now, the biggest issue in NTC is underwriting. Right? Personally, I feel if you remove underwriting from the equation, then the problem is solved. Right? And how? Now, the thing that we thought can be done is to tie customers finally need a solution, a proposition. Right? Now, some customers may get that based on their credit history or their employment, some may get based on some documents, some may basically get it using deposits. Right? But the idea is that how do we build the right customer perception around deposits? That you pledge the deposit, use a proposition, and get done with it, and even build your credit so that tomorrow you can graduate to an unsecured or a larger pay. That is a solution which I think can be the fastest remedy to kind of solve and expand credit. Versus trying to solve for credit through multiple different traditional and non-traditional data, so that continues. But the opportunity is so big, and with the proliferation of UPI and other digital payment modes, this has become sort of, a table stakes for many. And therefore, I strongly feel that remove underwriting from the equation, go back to basics, and try and expand it.
So interestingly, you touched upon product and UPI, right? So let me come to that part of the conversation, which is we've seen models help expand the customer segment. We've seen models are helping in the process as well as in risk management. How do we see that play out now in product innovation? Right? So traditionally, our unsecured lending or consumer credit has been typically the bullet lending, like the term loan type of structures, varying credit card, which is like a line product. But with the emergence of thoughts like credit on UPI, for example, we have an opportunity to actually create more line type of products for retail consumers and go beyond probably traditionally carded segment as well as we think about this. Right? So, any thoughts on how this will evolve from a product innovation perspective? Maybe we'll start with you, Amit, and Chitrabhanu, if you can also weigh in on that.
So, specific to credit line on UPI, it's a completely new use case, and where kind of payment and credit is coming together. Otherwise, we have always treated payments as a separate business and credit as a separate business. I think this would be the first use case when both of them kind of fuse into each other. Now, given that velocity is expected to be very, very high, and then there are linkages and limit management, backend systems, etc., etc. I believe that it is going to create a completely new customer segment. I think this is a financialization at scale, or you can say fintech at scale opportunity, where that 0.5 billion customer who are already active on the payment side, but they do not have access to credit because of not having a bureau score, and they are not fitting into any of the scoring models of the bank. They would come into the credit ecosystem, and then eventually they will graduate to bigger and better products like credit cards and personal loans because they would create a bureau system.
I believe credit line on UPI is going to be something which is going to test banks in some sense. We have been quite shy in terms of that profile of customers to reach out to them and give them some credit. So the point which he was also mentioning about, can you keep the underwriting out of this equation, consider this more as a payment product? But it's going to be something difficult for us because we have to look at what happens subsequently. How do you collect from this customer? One positive side of this product is that you exactly know what does the customer going to use this money for. It's not going to be a cash payout in some sense. So he's using it for a specific purpose. That's a positive comfort for us. But since it's got no bureau footprints, and these are going to be generally the younger set of customers who are just getting into this journey of banking. So those customers, giving them a very small limit and seeing how they are working is going to be something which banks are going to work on. I believe that to start with, most of the banks are going to look at pre-approved limits for these set of customers rather than giving it for their NTB set of customers because that's a slightly more risky proposition. But once they test waters and see how it's working, they will slowly look at migrating it to a slightly more higher set of customers. Once we find things like account aggregator, etc., getting a little bit more steam. So I believe it will take some time, but at some point of time, this is going to reach out to a larger set of segment across the country rather than just putting it in bigger markets. So it's something which is expected to explode and come over a period of time. This is what I think about it.
So actually, as a bureau and as an ecosystem, we've been trying to educate consumers on how to do the right things to, make your credit score look good or reflect the right reality to some extent. And I think Shirish spoke a little bit about what consumers are doing to, like using secured credit kind of formats to help them with some credit history. But as we look about the evolution of all these data sets around us, we've spoken about how banks and credit can evolve, but what should a consumer do? Right? How should a consumer think about saying, hey, what do I get right to make sure that in the right time and the moment of need, I get the right experience?
I think fundamentally, the consumer should borrow only if there is a need to borrow. That I think is very fundamental. We are often swayed by ease of journey rather than whether there is a real need to borrow. So as a consumer, I think it's super important. Borrow if you need to borrow. That is very, very important. I think both the consumers today are much more aware about their credit bureau, for example. I believe with the data protection, the consumers will also be more aware of the fact that they become owners of their data. And therefore, that will make the consumer do some choices, and that may change some journeys for the lenders. I think fundamentally these two things are going to happen from a consumer behavior standpoint. The first one we are already seeing on the credit bureau. Basis that, I think the second one is likely to happen.
Maybe we have about 4 minutes to close. I can take maybe 1 or 2 questions from the audience if there's anything. Ladies and gentlemen, we have just about time to take 1 or 2 questions. If you do have a question, please raise your hand so we can have a mic brought up to you. I can see someone at the back and there. Can we get a mic to him? Yes, we have another gentleman also here. We will have the mic brought over to you. Request you to kindly introduce yourself and then ask your question, please.
Hi, my name is Amit. I'm from ICICI.
Can we have another mic, please? Yes, it's on, sir.
Hi, I guess you can hear now. So, just taking a cue from the fact that probably the reason you made this statement, Subhrangshu, is probably a lot of people have borrowed when they need not have, and for other reasons of enticement, lower costs, whatever the need be. We're probably seeing some of those problems comes to roost. That is also the reason why new to credit acquisitions are probably much lower than in the past. There is a significant aspect to it, but in terms of, if you look at the profile of people who earn a certain minimum income to which credit cards can be served or even low ticket loans can be served, do we really think that the Indian market is super under-penetrated, or the people with wealth are already penetrated enough with cards and products that it's going to be a more moderate growth from here? The reason that is more specific to credit cards is because the institution actually does not make money off good folks, right? They lose money on bad folks as well as good folks. You only make money in the middle. So choosing the sweet spot, how hard or easy is it?
Shirish, do you want to pick up that question? I think what he's asking is the evolution of the new to credit segment. It's always cyclical, but at the end of the day, is there really that much under-penetration of a segment, especially in credit cards, given that the money making is not that easy with all segments of customers? And will we see unlocking of growth further, or are we going to see more moderate growth?
So, of course it is under-penetrated, and why I say that is because cards, like Subhrangshu also mentioned, I don't see that as credit, but the majority of cardholders today use it as a payment instrument, and there are very few who use the credit in it. Obviously, banks make money out of those customers. So yes, it is under-penetrated, and because credit is required, and it's a proven fact, right? Maybe not today, but tomorrow. But if you lace it with payments, if you lace it with a rewarding payment, it actually becomes quite lethal and quite potent. And we know, I mean, there are obviously challenges to reach out to those customers and all. But the other big reason why monies or the margins are shrinking is because the cost of acquisition has traditionally been high, which because of the digital outreach is now being cut. Right? And the availability of different data sets is also making portfolio management far more sharper. Right? So if you add these two, and the ability to scale and the proliferation of UPI on top of it, I think it's a potent model, both for the consumer side, as well as from a bank side to be able to have more customers into their fold and be able to make money.
Maybe one last question, you run out of time, but just...
So we're very sorry, we have absolutely no time. Just a very quick question, if any one of you do have. Ma'am, right there. For the rest of you, I'm so much sorry we cannot take your questions on this forum here, but we look forward to you interacting with the panelists offline. For now, ma'am, please, your question.
This is Pani from Axis Bank. My question is related to identity fraud. So, as mentioned by you, there are various alternate data sources like telecom, social media, food delivery apps, and all where customer behavior based on the telecom footprint can be seen to get more insights on the possible identity fraud. So, on this particular aspect, where does the data protection come into picture? As a customer is the owner of his own data, gathering the footprint, digital footprint of the customer from all these sources, what angle should be touched within data protection? And is there any possibility of violating any such norm?
Amit, do you want to take this one? I think the correlation she's trying to drive is between data fraud and data protection. Right? So the risk of data fraud is always there. But as we are getting into consumer owning the data, how can the consumer protect their data as well? Right? So I think that's the line of question.
So how can banks ensure to use the data without violating the data protection act?
And how can banks use data without violating privacy?
So one is that there is already a consent framework. Most of the customers these days also apply to bank through other third-party applications, whether it's a TPAP or it's an aggregator app, etc., etc. So they have already given consent to those applications to store their data before the applications move to the card issuing bank. So they download an app and they give consent. So Typically, there is already a master direction of credit card for other products also. There should be some regulation I am not aware of. But banks do not share any data outside their ecosystem. That's a complete no-no. That's number one. Number two is that now technology makes it possible for you to deliver data on other apps without the other partner having the ability to view or store that data through a API or through a software development kit. So you will see that customer servicing can also be done on third-party apps without actually the third-party app owner having any access to that data. It is only visible to the customer. The customer can also transact. So a bank can directly engage with a customer on a third-party app without the app having any access to that data. So those models are there. Have I answered your question?
Yes, sir.
All right. So I just add to it quickly is that see, banks and regulated entities of they are security centric, they are privacy centric, and they operate within a guardrail. But when it comes to fraudsters, they have no rules, no guardrails. So it is best left to the customer to kind of guard and understand what is the trusted source or not. Right? You have to be owning your data. Is how I strongly feel about it.
As we can see, this is a very passionate topic. We can go all through the day, but we will also respectful of time. So, thank you everyone. It's very clear that definitely financial DNA of a customer is going to be real. It's going to keep evolving and forming itself. So, look forward to that journey as we go along. Thank you.